Good afternoon, everyone. This is Kim Schmidt, Executive Editor of Farm Equipment Magazine. Welcome to our latest webinar in conjunction with the Western Equipment Dealers Association. Today's presenters are Eric Wareham and Curt Kleoppel. Eric's the Vice President of Government Affairs for WEDA and plays a major role in expanding and enhancing WEDA's state advocacy network by working with legislators, governors, and their staffs on legislative activities that impact dealers. And Curt is the CFO for WEDA and the President of Equipment Dealers Consulting. We've got a lot to cover today in the webinar, and we're going to aim to wrap things up within an hour. There is a chance we may run a little longer than that, but we are recording the webinar and there'll be a replay available on the Farm Equipment website. So if you need to drop off, we understand, and you'll be able to catch anything you missed. Before we get started with the presentation, just a couple of housekeeping items. On your screen, there's a control panel with the Q&A icon, and you can submit questions here at any time during the presentation. And then if for any reason your internet connection fails and it looks like the webinar has been interrupted, just go back to the email you got and you can re-enter that way. All right, we are ready to get started. Thanks again for joining us, and take it away, Eric and Curt.
Good afternoon, everybody. This is Curt Kleoppel with Western Equipment Dealers Association. We hope that everybody is healthy and stays healthy. We'd like to thank Farm Equipment Magazine for putting this webinar together on such a short notice. And also I'd like to thank Eric for milling over 880 pages of bill, especially over last weekend, and turning it around in good fashion and very quickly to our members and to get this webinar started. Again, the information that you're going to be seeing on this webinar is as of the guidance that we had as of yesterday morning. There's still more guidance coming out on several different programs, especially a lot will probably be out tomorrow, and we'll talk about that in this webinar. So Eric, take over, and thank you for it.
Yeah, thanks, Curt. Appreciate that. So there is a lot to cover, and we'll jump right into it. On the public policy response, we're going to go over just sort of the background on phase 1, 2, and 3, how we got to where we're at with the most recent legislation that came out on and was signed into law by the president on Friday. The first time we had eyes on this legislation, the full legislation, was a week ago today. So a lot has happened since between now and then. We're going to talk about the phase 3 individual components, and then also the phase 3 employer elements of the bill, which are important to you. And we're also going to talk about the major business lending provisions, the Paycheck Protection Program, and then we'll have mid-sized to large business relief as well. So we'll be covering all of the different programs that are available, both for small and large businesses. And so it should be relevant in multiple regards for everyone on the call here. Then we're going to go over tax provisions. Curt will give us some insight on the changes to the Tax Cut and Jobs Act and how that can benefit you as well. And finally, we'll wrap up with some of the agriculture provisions that are in Division B of the legislation that will probably be affecting your customers in a positive way. So that's the good news. Our goal here is to really break this out so that you can understand it and have useful information to make decisions going forward. Our goal and intent is not to throw a bunch of the legislation at you to try to confuse you. So we've done our best here to try to walk through it in a most understandable manner. So with that in mind, I think we were just going to start with a little bit of background on the size of the package, the reason for the size and the boldness of the package. And what I kind of want to start with is that it's obviously a medical emergency, but it's quickly transitioning to an economic threat. We've been on calls with the St. Louis Fed Reserve Chairman, who estimates 32% unemployment eventually, and a $2.5 trillion economic loss. That number will become important in the next slide as we talk about the size of the package. That 32% unemployment, when he first said that, I didn't quite believe him or give it the credence that I guess it was worth, because today they did come out with 6.6 million new jobless claims this week. So we're inching towards that very quick. So it's very important that all of the implementation of everything that's included in the bill is done right, so that we inject that liquidity back into the market and keep people from defaulting on their mortgages and such. Pew Research poll, 33% of folks surveyed lost a job or had reduced wages due to COVID-19 already. So we're definitely seeing an effect, which has led to the congressional responses. Most, as we go through this, most probably recall that we, as early in March, when it was just beginning to be a threat, Congress responded with $8 billion allocated to health-related funding. There were really no provisions at that time because we were somewhat unaware of the impending economic threat that was heading towards us. Phase two, as we started to see the effects of Corona and people started to stay home and we began to see shutdown orders and the like in larger cities, Congress responded on March 18th with the FFCA, and that really deals with the mandatory paid leave, the coverage for COVID-19 testing, unemployment insurance funding to some extent, and then the tax credits that relate to FMLA and sick leave. We don't have time to cover all of that, but I do want to let you know that that is available on WEDA's website. We have a coronavirus resource center, so you can go there and we have some summaries and briefs of that legislation. In fact, there was some guidance that came out today on that you'll be able to find on the website as well. So phase two, this legislation became effective yesterday. So we're fast moving. And between this phase two and now, we've had phase three, which was March 27th, the Federal CARES Act. It's a $2 trillion relief package, which makes it the largest relief package of its kind in history. When we go back to 2008 during the Great Recession, that giant package was about $800 billion. And then here also, there's a potential for $4 trillion in Fed Reserve economic support to pull different levers in the economy to keep it propped up if need be. And then phase three really includes what you've been hearing about in the news all week, the individual, employer, and tax provisions to, again, inject liquidity back into the market. We're going to jump right into it, starting with the major provisions for individuals. The number one and most well known is the automatic payments to individual taxpayers that's going to take place in the next few weeks. And these are $1,200 per individual, $2,400 for a joint return, plus $500 per child, phased out, of course, for some higher income earners. And this is going to be automatic. It's based on your 2019 returns. So, for instance, for me, I've had a kid since then, so I won't get the $500 from that 2018 year, but I will get to include that as a refundable credit in my 2020 taxes. So that's the first number one provision that's going to help all of your employees that are still working and those that are out of work right now.
Hey, Eric, on the provision for the individuals, the automatic payment, it is also based on 2018 tax filing if you have not filed 2019 yet. So
right.
If you haven't filed 2019, it's based on 2018, just to make it clear.
Yeah, and then I think there was some guidance again today. Treasury was talking about if you didn't have a tax return, you weren't going to receive it. A lot of people who are on fixed income Social Security don't have tax returns, so they've caved on that, and they're going to now include, if you're on Social Security, you'll automatically get a payment even if you haven't filed taxes. So
correct.
Still moving. And then the other thing that's major provision for individuals is the expanded unemployment provisions. They've kind of done away with basically all of the different barriers to obtaining unemployment insurance. And the biggest thing is probably the additional $600 per week on top of regular state benefits. Senator Ben Sass from Nebraska had an amendment to try to stop this. A lot of people will end up probably making more per week than on unemployment than they did while they were employed. And so that creates an issue when it's time to return to work. There may be some people that use this benefit until it runs out because it's good for 4 months. Eligibility ends when an individual can return to work. That's somewhat vague and ambiguous. And then benefits provided through the state unemployment offices. And I'll say that most states around the country have removed their waiting week and have extended eligibility. So if normal unemployment benefits were available for 16 weeks. Most of them have tacked on about 10 weeks to make it 26 weeks and remove the waiting week. There's an issue here going forward about the solvency of state unemployment insurance funds. States like Kansas, I know, are very solvent, but there are a lot of other states that don't have a large reserve, and so they're going to be waiting on a lot of federal funding to be infused so that they can meet the demand that's growing. So we'll keep monitoring that as we go forward as well. So next up, we're going to jump into some of the provisions that apply to all employers. This is regardless of your size. What we want to stress here, I think Curt can add to this, is that there's a lot of interdependency in the legislation. So if you use one program, you can't use another, and vice versa. We have a slide later in the presentation that'll kind of seek to explain that interrelation between the different programs. But just know as we walk through, we'll be getting to that and then talk about our insight and advice on what are the best programs to use. So with that said, we'll start with the payroll tax delay. The delay payments, it delays payments of employer payroll taxes, that Social Security portion, from enactment through 1/1/21.
Yes, and that's based on the 6.2%, correct?
Yep, that's right. And then here's the tricky part about the payroll tax delay. This is delayed payments, not forgiven. So you have to pay this back. It's just delayed. So 50% due on the in 21, and then another 50% due in 22. Curt, you have some misgivings maybe about this.
Yeah, I mean, I guess, it's a good cash flow relief, of course, because it is 6.2, and if you have quite a few employees, that can amount to quite a few dollars, and it doesn't cap out until like $139,000 per employee. So you could mount up to a lot of money. What I worry about is that 2-year delay. What happens if 2021 is not a very good year, and then you got to come up with half payment, and payroll taxes are never forgiven. So immediate cash flow, yes. In the future, could be more of a hurt. Who knows?
And not as advantageous as other programs we've seen.
Correct.
And that's one of the issues with the payroll tax delay as well, is it's unclear right now how it interacts with the payroll tax credits under phase 2. We're waiting on guidelines from Treasury. And what we mean by that is under phase 2, if you have individuals that were on sick leave or FMLA due to COVID-19, that you had a refundable tax credit against your employer portion of the payroll taxes as well. And so, Curt, maybe you can talk to that a little bit.
Yeah, and that, we still need some more guidance on that, but technically, if you have an employee that comes down with COVID-19 or a family member, or has to take sick leave for daycare or to take care of a family on COVID-19, then you would get a payroll tax credit by quarter, refundable. So, I think that would be a pretty good program to get on. Hopefully, we don't have to use that because, again, it's mainly, you hope your employees don't catch it and things of that nature, but it is there, and I think it's a pretty good program to take advantage of if that situation arises.
Yeah, and the main issue with this one is that it does not apply to businesses using Paycheck Protection Program. So if you use the PPP, as we call it, is also what the SBA Small Business Loan Program is. So if you're using that, you're ineligible to use this. So it's one or the other, either or. And we'll talk about that again later. The next program that we have is the Employee Retention Credit. The way it works is that for employers fully or partially shut down by a government order, 1, or 2, have a 50% drop in gross receipts in a quarter compared to the prior year, will have some relief. And you'll have relief until you return to the 80% of your gross receipts that it was before. The way it works is it's a refundable tax credit against your Social Security payroll tax. And Curt, maybe you want to talk about that a little bit.
Yeah, and we talked about this yesterday, Eric, that a lot of our large ag stores are essential businesses. So the partial shutdown by government order would probably not apply in this case. So then we'd have to go the route of the 50% drop in gross receipts in a quarter, and that could affect quite a few people. We've been talking to dealers all across the United States, and some say this first quarter has been pretty good. So I don't know if everybody's had a 50% drop in gross receipts in this first quarter. I do think it would apply to a lot of our outdoor power equipment dealers because sometimes it depends on your locality and what the mayors have done in each different city, whether or not they are considering essential business. So, I think it'd be worthwhile to apply for. And, we had a question on this 10,000 per employee. So hopefully this answers a question from that participant on how that applies.
Yep, that's right. What it basically comes out to is a max credit of 5,000 per employee.
Right, and again, it's just based on the Social Security part.
The important part here to remember is that if you're an employer with more than 100 employees, the retention credit only applies to employees that are not providing services because of the shutdown or the 50% drop. If you're 100 or less, it applies to all employees paid during the eligible period. So that March 12th through the January 1st, 2021. And another thing to remember, again, it does not apply to businesses using the Paycheck Protection Program, and we'll talk about that in the future. The big program that I think all of you have heard about and are curious about is the Paycheck Protection Program. This is the Small Business Administration 7A loan on steroids program. They've allocated $350 billion to it, which I've been on several calls about this, and it sounds like that they should have allocated more like $1 trillion to this, given the eligibility requirements that they've opened it up to. And we'll talk about why that's important here real quick. As far as eligibility is concerned, it is small businesses under 500 employees, and employees are counted as full-time, part-time, and seasonal. I know we had a question that I want to address at this point about, and I've heard it from dealers of different brands now, is this idea of waiver of affiliation rules and being a franchisee that is assigned a franchise identifier code. That section is under Section 1102D4 of the waiver of affiliation rules in the legislation. Affiliation rules are designed to prevent, not include, bigger businesses from accessing SBA programs. So the way that works is if you were a franchisee, it would actually be worse for you because you'd be counted as part of the number for Case or Deere or whomever. And so there's only 2 exceptions for that under 500 employees per location. You have to be part of an NAICS code beginning with 72. So basically that's restaurants and hotels. So if you have less than 500 per location, you're eligible. That's not the case for equipment dealers, unfortunately. So with that said, that's kind of where we're at on eligibility. And I know we have a lot of people that are really close to the line on this. As far as the loan amount, I'll let Curt get into this, but it's basically the average monthly payroll times 2.5. There are guidelines about when that average monthly payroll is calculated, and it's capped at $10 million. There are some limitations, including you can't count wages over $100,000 and excludes federal payroll tax and FMLA sick leave.
Yeah, and I think, for the most part, most of the people to figure payroll costs would use 2019 monthly average for payroll costs, and your payroll costs would include salary, wage, commissions paid, any sick leave pay, any payment for vacation, payment required for group health care benefits, including the insurance premiums you pay, payment for any retirement plan like 401k matching that the employer would do, and then also the payment of state and local taxes that the employer pays. That all gets in the figure of your monthly payroll cost. So you take your total monthly yearly payroll cost, divide that by 12 to get your monthly average cost. Take that times 2.5 times, and that would be your loan provision. So by the time you add up your wages, what you pay state and local income taxes, what you pay for health insurance premiums, and any 401k matching, that could be a pretty substantial dollar. And that's why Eric said the 350 billion sounds like a lot, but some of these people that are, have 400 employees, that 2.5 times could be $5 million loan to those businesses. So that can add up pretty quick. What we know now, it's mainly on a first come, first served basis. Most of the banks, if you got a good banking relationship, I would call up your bank to get the application. There's a application on our website that has a sample format that we think that's what it's going to be. Our bank has sent that to me, and it's on the SBA website too. It's a fairly brief form, basically 2 pages, and so I think it's one of the better programs for most of our dealers to apply for and to access. So I think, if they keep it this simple, it should work out pretty good.
Yeah, and so here's some of what makes it so attractive is that they've come out and established the 2-year term at 0.5% with deferred payment for 6 months. So essentially, when you get this loan, you use it within the 8-week period of loan origination on your payroll costs and things like that. We'll get into that. But you're basically not going to be out any money at any point, because by the time that you use that and then you submit for it to be forgiven, you're not going to have a payment. Is that about right, Curt?
Yeah, and some of the other information that you need to get ready for your process of your application is that you need to prove that you're in business as of February 15th. So print out your articles of incorporation, a certificate of good standing, your partnership agreement, or some tax filings that show that you're in business as of that date. You'll need a copy of your W-2s that you had for the last year. Independent contractors, which I don't think applies to our dealers, but you'd have to show a 1099-B received, and then also number of full-time employees that you have as of February 15th, 2020.
Yeah. One of the other great things about it is that it requires no personal guarantee or collateral put up. Curt, you've been going through this process on behalf of the association. Is that your experience?
Yes, and that's huge because, I started with the 7A, I believe, Eric, SBA 7A loan.
Right.
And, they ask for some personal guarantees, or can in that case. So for them not to ask for a personal guarantee or collateral is pretty huge, especially if you're looking at, $100,000 loan with a business that might be doing, $1 million of revenue. I mean, that's pretty significant. You're not going to find that opportunity too many times, let alone if a $5 million loan, on some of these other, larger employers.
Right. And I know we're getting a lot of questions right now. We're trying to answer them. There's some that will be answered as we go along, and then we'll also have time at the end too to answer as many as we can. But moving along through this, to your point, the loans are going to be made by local and national lenders approved by the SBA. So you need to reach out and find out, like Curt said, if they are approved. Not all are, but they're moving towards all of them being approved. This is a really essential element of the legislation, and I think a big change from just having the Small Business Administration approve and process all of these loans. They simply don't have the capacity, and pushing it out to the market to handle that, I think it also ensures that there'll be liquidity in the banks going forward too, don't you think, Curt?
Yes, and in fact, I was very happy to hear that, they had some national lenders already approved because, going to the SBA website, I mean, it's going to get way overloaded. I mean, just like what happened to all the state unemployment websites. I mean, they've been overloaded and people been filing claims and already been denied because the states haven't updated their websites for the federal funding. So that could happen here with the SBA. So I'm glad they've approved some banks. And again, if you got a good banking relationship and your bank's been approved, that could be key.
And here's somewhat of a, I wouldn't say contentious, but it's not put out there that this is going to be a first come, first serve application process. If you read the Treasury guidance that has been issued, it repeats and reiterates multiple times that this is a limited funded program and that you should apply as quickly as possible. So what that tells me is that this will be first come, first serve. And when people start talking about if everyone were to apply to this, that would be eligible, that's applicable to, it'd probably be around $1 trillion. Dealers need to get after this quickly. The word is that they're going to begin processing April 3rd, which is tomorrow. Curt has been going through this process. He can probably speak to that a little bit more. We have been talking to some of our partners. I know West Texas Bank, for instance, and Commerce Bank. And what have they conveyed to you, Curt?
Yeah, I just talked to Commerce Bank this morning and West Texas National Bank yesterday, and they're still waiting for final guidance from SBA, especially on the application form. But once they hear that, then they're going to immediately start taking applications. So that's why it's kind of necessary for the dealers to gather this other information that you're probably going to need, like your articles of incorporation, a copy of your W-2s, probably proof of your health insurance premiums that you pay per month, and your gross payroll, and you're backing out any employees that are over $100,000. So if somebody makes $150,000, you need to back out that $50,000 in your calculation to come up with your monthly average payroll costs.
Yeah, and we have a jump start a little bit. They've broken up the dates. Small businesses and sole proprietorships are begin processing on the 3rd. Independent contractors and the like are on April 10th. So they're staggering it somewhat. And here's what some of the uses are. I know we had a couple questions about what it can be used for. Just to preface this, what it can be used for and what can be forgiven are different. Some of them overlap, but they're different. You can use it for payroll costs, group healthcare benefits, FMLA sick leave, insurance premiums, mortgage interest, rent, utilities, and interest on other debt incurred before the loan originated. There's some reasons why you might not want to do that, though, if you are looking toward getting the loan amount forgiven. And we'll get right into that. So on the forgiveness amount, it will be equal to the amounts used in the 8-week period from the loan origination date. You can spend it on 4 things and have the amounts be completely forgiven: payroll costs, mortgage interest, rent, and utilities. Treasury just came out with guidance, however, that not more than 25% of the loan proceeds can be used for non-payroll costs.
Yeah, and that's what's on the sample application that I've received from the bank, and it's also part of the certification that you have to go through. And it actually states that not more than 25% of the forgiven amount may be for non-payroll costs. Also on the certifications, and what they recommend is that, there are several, banks that might be in your area that are approved lenders. Do not apply to more than one bank, because if you apply to more than one bank, they'll automatically take you out of the certification program. That's one of the questions that you have to answer, that this is the only application that you're making. Okay.
That's a great point. That's a great point. So let's say that you apply and you've already laid some folks off, or you will be. There is a reduction for employees that are lost. However, it does provide an opportunity to rehire those employees within 30 days and maintain them to June 30th. So June 30th is also the date by which it's the last day you can apply for the loan. But as we discussed, you probably want to do it sooner or later, not wait till June 15th. As Curt said, you might not have the best chances. But if you do have to lay folks off, there is an opportunity to rehire them and maintain them. And it's basically on a per capita. As you lose employees of your overall, it reduces it by a pro rata amount. There's also
I think.
Oh, go ahead, Curt.
Well, I think, the big key is that, people are going to get this program to get them through this tough time, hopefully. And it's only lasting no longer than 2.5 months. So, I'd be my assumption that everybody would be retaining the same amount of employees as when they started, as what they stated on February 15th. So I think most of these loans would be forgiven, which would be huge. And it's not included in their income. I think we're talking about that next, so I might be jumping ahead.
We will get to that. And I do know one question that came in was, are you eligible for the loan if you don't shut down, if you keep going? Because a lot of our dealers are still working as we talk to them. No, you do not have to shut down. You do not have to have lost employees. You don't have to have lost revenue. These SBA loans are available even for businesses that are fully functioning and don't see any decrease or any drop in employees. So it is simply a way and a method for to inject liquidity back into the market, and so all the better if you're still moving forward. It also is reduced, though. The forgiveness amount is reduced by wages if you reduce wages below 25%. So be wary of that if you're looking at reducing wages for employees. And then treatment of loan forgiveness. Curt alluded to this earlier. Curt, why don't you talk about how that's going to work towards taxation purposes?
Well, again, if the whole debt is canceled, then it's not going to be included in your gross income. Now, what we're waiting for with more Treasury guidance is the deductions part of it, because they kind of sound like, okay, we're not going to include this loan amount in gross income, but if you use this loan for other things like, I don't know, maybe utilities of some sort that might not be part of your ongoing business, but if part of that's not canceled, then I think their thinking is that their deductions would actually be non-deductible on your tax return. But we're waiting for guidance on that.
Yeah. Yeah. And the other part of this is, as you mentioned, Treasury guidance. If you use loan proceeds to pay for things that are normally expensed, one of the questions is, will you still be able to deduct those expenses that were paid by the loan proceeds?
Yeah, and that's what we need to see, because if that's the case, then they're kind of you're not taking the loan into account necessarily in gross income, but then you might not be able to get some deductible expenses. But again, the way we talked yesterday, it's still a cash flow relief. And so if you're out some deductible expenses on your tax return and you take it times your tax rate, it's still a pretty good deal.
Yeah, that's right. So the next program that is available in the legislation is the SBA Economic Injury Disaster Loans. This is why you've seen every state now be declared an economic disaster area, because it opens up eligibility for these series of loans. So this is interacts with the Paycheck Protection Program, but it's really kind of after you get through that window of maybe 8 weeks using those loan proceeds to pay employees and other costs. You may still be requiring additional capital to keep your business up and going. And so that's what this is really set up for. Advantageous terms of up to $2 million for 30 years at 3.75. You have deferred payments for up to a year. And I know, Curt, you mentioned that's probably one of the biggest advantages of this program.
Yes, it is. And then plus the fact that, you can still do the Paycheck Protection Program too.
Right. Yep. And it's up to $200,000 with the personal guarantee. So anything over that, if you're looking at these loans, you're going to be on the hook for. And these do not have the same forgiveness as the Paycheck Protection Program. This is just a standard loan on favorable terms, right, Curt?
Yes.
These are available now as well, and the SBA is going to be these are going to be administered through your local lenders as well. So if you talk to them about the Paycheck Protection Program, you can talk to them about these injury disaster loans at the same time, and they can walk you through how that works. The eligibility requirements, again, are the same. They're primarily for small businesses under 500 employees. And we also promised we'd talk a little bit about the mid-sized and large businesses too. A lot of our dealers fall into that category. And those amounts will be coming out of Treasury instead of through the SBA. After distressed assets and payments to things like airlines and cargo carriers and the like, there is a remaining $454 billion that the Treasury can use for loans, loan guarantees, and support. That's not only for business, but that's also for local governments, municipalities, and states. So this money will be used in a lot of different ways. There weren't a lot of sideboards put on this, but it does say in the legislation and in guidance that has been issued that there's going to be a focus on mid-sized employers, those 500 to 10,000. Again, those will be through private lending, not direct. Interest capped at 2% and deferred payments. But there are a lot of requirements that go with it. The retention of workforce, no outsourcing or offshoring jobs for the term of the loan plus 2 years. And then, Curt, the debt is the loan is treated as debt for federal income tax purposes.
Yeah. So it's just considered a regular loan, and then it would probably also enter into your business interest deduction calculation too. But at a 2% cap, the interest expenses is going to be not as large as it would under normal terms.
Great. And that is kind of in a nutshell the extent of it for those mid-sized businesses over 500 employees. We wish we had more, but we're really just waiting on Treasury. This was sort of the undefined. The Democrats called it the slush fund, but it was just really undefined and gave a lot of discretion to Treasury so that they could shoot liquidity into different sectors of the economy that needed it. So we'll see what that looks like, and we'll continue to provide some information going forward. So how does this all work together? Kind of created a little flow chart for you here about the individual provisions on the family rebates, increased UI, that's individual again, the tax provisions, which we'll get into here in a sec. Curt will walk us through it. And then the different programs. Here's the main four that you see over here. In the middle is the Paycheck Protection Program. Those are the small business loans that are forgivable. You have the employee retention credit, and then the delayed payroll tax payments. So on some of these, you can't do both. So for instance, if you use the employee retention credit, you can't use the Paycheck Protection Program. If you use the delayed payroll tax payments, you cannot get your Paycheck Protection Program payments forgiven. And then, of course, you can't use both on the economic stabilization funds and the PPP. And what I mean by the reduced forgiveness there, if you see that to the left of the screen, is as you furlough people or have to let people go, they're going to be covered by the unemployment insurance benefits, and your benefits go down commensurately. So, Curt, when you look at this, and again, we'll get into the tax provisions, the family rebates are automatic. The increased UI payments are automatic. That's injected in the economy. When we look at these different programs, in your mind, what's sort of the best route for dealers to take going forward?
Well, definitely the PPP program, especially if you're under 500 employees. If you're over 500, then you're going to have to look at the, mid-sized to large SBA loan route, or the delayed payroll tax payments. But other than that, I think the majority of our dealership base, I think, would look heavily at the Paycheck Protection Program and get that cash flow assistance for, 2.5 months, which I think could be huge in a lot of cases. Because if you stop and think, if you don't have to worry about payroll for 2.5 months, that frees up your cash to do some other things, inventory being due, things of that nature, and just, other ongoing expenses that will crop up, that will happen.
Yeah. And again, this, Kim mentioned it. I know someone asked, this webinar is going to be recorded. We'll make it available to you so you can go back through it. And of course, we're always a resource at the association. If you have follow-up questions that we don't get to in this presentation, Curt is president of EDC and does a lot of tax preparation as well. So he's always available for that, and then for advising if we don't cover you. What we've talked about so far, I think I threw up this slide because it's important to step back for a second as we talk about all these different programs and the way that the Federal CARES Act injects liquidity into the market. A big criticism back in 2008 of the stimulus package was that it benefited largely the wealthy. This is a nonpartisan analysis here of the Federal CARES Act and the rebates that are coming. You can see that the distribution is very even amongst the different income quintiles and actually skews towards the bottom quintiles. So the relief that is coming out is really directed at those who are probably hardest hit in losing jobs and the like. So keep that in mind as we go forward and we talk about these large amounts for business. Really the meat of it is going to individuals, and then it's helping employers, but in the sense that it's helping employers only if you're retaining your employees, and everything is geared towards that. As we hopefully come out of this, flip the switch, and things start to crank back up. Now we'll jump into the tax provisions. There were some changes made, and I'm going to let Curt just talk about these as we go through them. Curt, what do you have to say about the tax delay? I know that's been a never before done, right?
Yeah, I've never seen it before in 38, going on 39 years. So one part of me says I'm relieved. The other part, I wish I would never see a deadline of July 15th. And then
Right.
saying that, I mean, most states have gone with the federal deadline. I saw Idaho. I haven't confirmed it yet, but it seemed to me like Idaho was still either showing April 15th or June 15th deadline. And I'll check that out again to make confirmation. But all the other states that I've checked have been following the federal guidelines. Also, IRS came out on Wednesday and extended the gift tax return and generation skipping tax payment and tax return to July 15th too, which is pretty huge. And then most of the local, like Kansas City has a local earnings tax, and St. Louis does too, and some of the other bigger cities. and they've extended those payment deadlines to July 15th. Still checking on some of the states, have no income tax like Texas and state of Washington. And like in Texas, they have their franchise tax, which can be a pretty good size payment. I haven't seen where that has been extended yet, but I'll check into that. So again, most everything is July 15th.
Good deal. The next is a change to the net operating loss carryback provisions, and not probably super important to our dealers, maybe some.
Yeah, I mean, it used to be carry back to 2 years on the federal side. Now they say you can carry back to 5 years. So, hopefully we don't have a whole lot of businesses having a loss year in 2020. But if that happens, then you can at least go back and recoup some of the taxes that you paid in 2019 or 2018 or 2017 or 2016. If you go back to 2015, you might have had a lost year because that's when we were going through the used inventory crunch. So,
Right.
but overall, you can still get some money back.
The next one is the corporate alternative minimum tax. And I'll let you go ahead and talk about that.
Yeah, I mean, that's a good thing. I mean, some applies to some people and other people it doesn't. So if it's applicable in your case, then you got some relief on that too.
The next one is they've increased the allowable interest deduction, and maybe you can talk about this, the importance of it, and then how it works with the floor plan interest amendment, which you and I worked on a couple years ago now.
Yeah, I mean, it shouldn't affect our floor plan interest deduction because that's still in tax. So you'll be able to take 100% of that. What it could affect though is your other business interest, your capital and operating loan interest expense. And, so it's big moving it from 30 to 50%. But like we were talking yesterday, if you're showing a loss, then, it doesn't matter 30 or 50%. That business interest is not going to be allowed, which if you're showing a loss, you don't need any more deductions. But if you're showing income, then this is big, and you're going to probably see more people have operating loans, which would increase that business interest deduction calculation. So it's nice that they went from 30 to 50%.
And the last one that probably will have a larger impact on our dealers is the qualified improvement property, the QIP, and maybe you can talk a little bit about that.
Yeah, the qualified improvement property, I mean, you can get pretty much a quicker write-off. In fact, you can get 100% write-off on improvements made to property. Now, that really only goes towards existing buildings and what you do inside. If you add on square footage to an existing building, that does not count. If you build a new building, that does not count. But, with cost segregation being big nowadays in buildings and doing the cost segregation, you can increase your write-off through shorter life periods and get them to qualify for 100% deduction. But now's the opportunity. If you got an existing building, you want to put some improvements in it, then you could write off 100% of it.
And this is retroactive back to 2018. So if you already had improvements, let's say that you did in 2018 or 2019, it would operate to amend your taxes then, right?
Yeah, you could go back and amend the tax return and get the deduction and file for refunds. Yeah.
Yep. Good deal. And that pretty much wraps up the tax provisions, the major provisions that are included in the legislation. And the last part that we're going to cover, and we'll take some questions. I know there's a bunch piled up. In the Federal CARES Act, the Division B relates to funds allocated to governmental entities. And as part of that, their agriculture received a sizable chunk. So USDA, along with the Rural Development and FDA, received 34.5 billion. 9.5 of which went to the Office of the Secretary, largely discretionary funding to help impacted producers and of specialty crops and local food system supplies and livestock producers. Another 25 billion went to additional SNAP funding and food purchases. And then the final amount that I think is interesting is that there was 15 or 14 billion allocated to the Commodity Credit Corporation, which replenishes their borrowing authority. And if you recall, that is the CCC is what's used to facilitate the market facilitation program. So the USDA just released their third tranche of those MFP payments at the beginning of February. With this additional 14 billion, there is talk of there being a fourth tranche of those MFP payments going forward. The great thing about that is that in the past, anyone in agriculture was prohibited from applying for SBA 7A loans. They are now eligible as well. So your customers are eligible to sign up for the SBA program, even if they don't lay anyone off or if they're doing just fine. They can still get that money, still have it forgiven. So they have that, and then they may also, on top of it, get a fourth tranche of MFP payments. So even if there's some low commodity prices out there, there's going to be some backstops to still keep liquidity in your customers' hands, which is good for you, the dealer. So with that, that's going to wrap it up. For what we're going to go through, again, we did not address phase 2 and some of the sick leave and FMLA leave requirements that are now effective. But you can find that information on our website and some of the summaries there. And I think we'll open it up for questions and answers. I've been going through them, but Ken, maybe you have a couple that you've picked out that we didn't cover.
Yeah, I have. Let me see if I can find it again. Well, I remember it basically enough. If someone, if a dealer has to let someone go because of performance issues or things like that, does that impact any of the benefits, employment benefits?
Yeah, so any reduction in employees in the period from February 15th to June 30th that is different from that average payroll, for whatever the reason, reduces your amount. So I know I saw a question too, what if somebody quits? I don't think that would necessarily be held against you, but you can, if it is, just because this legislation was so rapidly made that those are kind of the loopholes that were left out and not addressed. But you have an opportunity to rehire someone for that position and maintain your staffing levels so that it's fully forgiven. But there's not a lot of distinction in the legislation about reasons why you have employees leave.
Okay. And then what were the dates that should be used for payroll to calculate that average wage?
Most people would be using 2019 for that whole 12-month period, and then you take the average of that. Now, if you're a seasonal employer, then they're looking at the average total monthly payments for payroll should be the 12-week period beginning February 15th, 2019, or at the election of the eligible recipient March 1st, 2019, and ending June 30, 2019. So they're looking back at that year period. So most Commerce Bank told me to look at 2019 payroll and take the monthly average.
Okay. And then just a quick note to any dealers from Canada who might have sat in on this. We are still waiting on details from the finance minister on the CDN program announcement that was made April 1st. And WEDA's working with their partners too, and we'll send out information when it's available. then another question. Oh, sorry, it's bumping around, moving fast. Can you clarify what goes into the calculation for the PP loan amount? So, for example, do you include what you pay monthly in rent, your utilities, etc.?
As far as I know, with the guidance that I have so far, is the payroll costs consist of salary, wage, commission, payment of any cash tip, which does not apply in our industry, payment for vacation, parental, family, medical, or sick leave, payment required for your provision of group health care benefits, including your group health insurance premiums, payment of any retirement benefit, which would be your 401k match, and then also the payment that you have to state and local tax on the compensation that you pay your employees. So that is the definition of payroll costs. I think where the confusion gets in is that you can use the loan for rent and utilities and things of that nature, but that's not really part of your payroll cost.
Right.
Right. Yeah.
Yep, that's correct. Kim, I had an interesting question way up at the top of the hour that I wanted to address. And
Okay.
Is the $600 additional unemployment available for reduced hours unemployment claims? That's a great question. There's a lot of states right now that have programs where if you have half-time individuals, that the state will match the rest of it and provide unemployment benefits to equal what it would be full-time. There is not guidance right now on whether that $600 can be used in those instances. And so that's a great question, but I know that that's a pending question that's out there.
All right. And then we had another question related to terminating employees. So if a dealer was to terminate an employee prior to applying for the loan, will that still count as a reduction in headcount?
Yes, because it's before February 15th, right?
Yeah. The
Because you gotta list your full-time employees as of February 15th. So if you fire or dismiss an employee before your application date, I think that would still be in that period.
correct.
Or do you think it's from the application date to June 30th?
Yeah.
If it's that, yeah.
It
So
is.
if it's that, then I think it'd be okay.
Yeah. Yeah, it is as of it goes up through, going back through here. We can get to that. I'll come back with it.
Okay. Because that's why they're asking for how many number of full-time employees you had as of February 15th, so then they can base it off of that.
Yeah, that's correct.
So this is a sort of unique question, and it may actually apply to a fair amount of dealers. What if a business merged with another company, in 2019? Do they take the January 1st to February 29th, 2020 payroll, or is that something different?
Well, they wouldn't be seasonal. It would still be the average, but I think under those circumstances, they would probably look at the merged entity. And if you had some business event it's not spelled out in the legislation, but Curt,
Well, it sort of is on this application now, but I don't know if this would qualify because both of you were in business and you merged. So
right.
The only caveat would be is for an otherwise eligible borrower that was not in business during the period beginning February 15, 2019, and ending June 30, 2019, then you would look at your payroll costs incurred beginning January 1st, 2020 and ending on February 29th, 2020, but you might have a hard time saying you were not in business, so to speak. That would be something that I would probably use the 2019 calculation and submit it to the bank, and then they would tell you otherwise if, you could use January 1st, 2020 to February 29th, 2020. That would be my recommendation.
And then, Eric, any other questions you saw come in that you wanted to address?
Let me go through and see.
This one is kind of a quick one. What, with the applications being accepted tomorrow on April 3rd, is that midnight April 3rd, or is that starting once banks open at 9 a.m.?
Well, that's to be determined because we haven't, we don't exactly know that it's going to happen tomorrow. That's
Okay.
the presumption and that's the expectation, but we don't know if that's for sure. It might not be until Monday, because if SBA doesn't give the final application form out to the banks and the lenders, and they understand the qualifications and the information necessary to start approving these loans, then it might not be until Monday. But I would think it would start as of 9 a.m. when the bank would open.
Yeah, I had a question about what do full-time employees need to work their full hours in order to be eligible for the to use the PPP? No, you just have to pay your employees and show them show on your payroll certifications when you apply for forgiveness that they were paid that. They don't necessarily need to work their full hours, but you do need to. You cannot reduce their compensation by greater than 25% from their full-time wage. So if they're working less hours, that also, they can't fall below that threshold.
Okay. And then if anyone has questions that we didn't get a chance to answer, is there a way that they can reach out to either of you with those questions?
Yeah, my email address, I think quite a few people have it, and both my email address and Eric's email address is accessible from our Western Equipment Dealer Association. But my email address is Curt, C-U-R-T, at westerneda.com. And I will try to answer. I'll try to answer as many questions that I can in an appropriate time manner too. Yep.
Okay. That sounds good. And we've had a couple more questions come through about the replay. The replay will be up possibly before the end of the day today, but for sure by tomorrow morning. So we will send that out to everyone who registered. So if you know someone who registered but wasn't able to attend, they'll get it as well. So feel free to go back and watch it or share with anyone else at the dealership. And then if you also want to, you can send questions to me and I can pass them on to Eric and Curt as well. My email address is kschmidt@lessitermedia.com. So I think that we will wrap it up here. Like I said, the presentation will be up on the Farm Equipment website in case anyone wants to go back and look at it. So keep an eye on your email and the Farm Equipment newsletter for more information on how to access that. And then on behalf of Curt, Eric, WEDA, and the entire Farm Equipment staff, thanks so much for joining us for today's webinar. Feel free to reach out to us and let us know of any other topics you want us to cover in the future. Thanks again, everyone, and enjoy the rest of your day.
Yeah, thank you, Kim.
All right. Thank you.